Good morning, everybody, and welcome. It's 9 o'clock. Let's get started. My name is Michael Steenkamp. I'm one of the directors in the audit department, as well as the head of IFRS. So normally, hopefully some of you might have heard me before speaking on specific IFRS topics. But today we're going to be speaking about something slightly different, and that is the new standards, or the proposed standards on sustainability reporting, and what the impact that has on businesses and investors. So in this webinar, what I'm going to be doing is firstly just how we got here, what is sustainability reporting, just to give a bit of an overview, a bit of a feel what sustainability reporting is, and hopefully give you a little bit of understanding and background to the standards, or to sustainability reporting rather. Then I'm also just going to do a brief introduction on what the importance of sustainability is on the business as well as your investors. And also then a little bit of an introduction to the two standards. You'll see, interesting, they're called IFRS S1 and IFRS S2 are the two current proposed standards on sustainability reporting. So we're just going to give a very brief introduction to those, a bit of background, a bit of understanding of what the requirements and the disclosures are that is proposed to be required, and hopefully just get an understanding for what this is all about. So just getting into how we got here. So global capital markets and demand are demanding for better information about sustainability-related matters to enable investors to factor in sustainability-related risks and opportunities in their assessment of enterprise value. Users, investors of financial statements, stakeholders are no longer just looking at your normal, typical IFRS reporting financial statement, but there's a big focus and a big shift for these people, for global markets, to be looking at sustainability-related information and disclosure as well, to get a total picture of enterprise value, and not just specifically financial. So it's a big trend, it's a big move. So that's how we got here. So what is sustainability reporting? Sustainability reporting refers to the practice of measuring and disclosing an organization's impact on the environment, society, and governance. So environment, society, and governance we refer to as ESG. Later, as we go through the slides, I'll be saying ESG. So that's what it stands for. So what is your impact on the environment, society, and governance? And then it helps your stakeholders understand how the company is managing the ESG risks and opportunities. So it gives them more information. It helps them, understand the business better, and helps them make better decisions when it comes to your business. So do I feel that this is important? I really do. And some of the benefits to sustainability reporting, in my mind, would be enhanced reputation. There's better, later on in the slides, I've got a slide that deals with challenges and opportunities for sustainability reporting, and also benefits of sustainability reporting. But just briefly, some of them I believe would be, like I said, enhanced reputation, better risk management, improved stakeholder engagement, better decision making. All these things I think are very important important aspects or results, should I say, of sustainability reporting. So how we got to these standards, there's two standards, like I said. There's IFRS S1 and IFRS S2, which are sustainability reporting standards. So what happened was there was a board, as we know the standard setters for IFRS standards is referred to as the IASB, the International Accounting Standards Board. There is now one called the ISSB, which is the International Sustainability Standards Board. They were formed to address this demand for sustainability reporting and to give guidance on sustainability reporting. So they have now proposed two standards to start with. And like I've mentioned, it's IFRS S1 and IFRS S2. And we will then look at these now briefly. So the first one is IFRS S1. So IFRS S1 is the general requirements for disclosure of sustainability-related information. So the general requirements exposure draft that's out now sets out the core content for a complete set of sustainability-related financial disclosures, establishing a comprehensive baseline on disclosing this and measuring these, for your sustainability-related financial information. So it just gives you the general requirements, set baselines, set goals, and what disclosures are required. So the general requirements exposure draft proposes requiring the disclosure information about significant sustainability-related risks and opportunities. The sustainability-related financial information disclosure would be centered, and I'll be referring to these, for lack of a better word, pillars, in more detail and quite regularly, but it wants companies to consider its governance, strategy, and risk management, as well as the metrics and targets it uses to measure, monitor, and manage the company's significant sustainability-related risks and opportunities. So that is just generally what it is, but in just going into a little bit more depth on each one of them and dealing with those different pillars of governance, structures, strategy, and risk management processes, let's look at governance. So what does that mean? What does, so this could mean and include the use of a sustainability committee, the establishment of your goals and targets, the integration of sustainability considerations into your business and into your operations. So the standard, when it refers to governance disclosure, refers to information that enables investors to understand the governance processes, the controls and procedures used to manage, to monitor and manage sustainability-related risks and opportunities. So how is the organization and the entity and the enterprise going about managing managing the sustainability risks and opportunities? So what do you got in place? Then the second, should we say, pillar, as I'm referring to it, would be your business strategy. So the sustainability. How integrated is the sustainability in your business strategy? So it's important, that you do integrate it into your business strategy and the company strategy. I'm going to say this a couple of times as we go through the slides. It's not, I don't feel, to be looked as two separate things. You can't have sustainability on the one side and the rest of the business carrying on the other. They've got to be integrated. And obviously, S1 gives guidance on how to integrate the two and disclose. The standard, when it refers to what to disclose around your strategy and the information, it's information that enables investors to assess the company's strategy for addressing significant sustainability-related risks and opportunities, whether these risks, opportunities are incorporated into your strategic planning. So when you're planning and monitoring the risks, are you incorporating these sustainability risks within your strategic plans, including your financial planning, and whether they are core to your strategy? So again, we're speaking of this integration of your sustainability reporting and your your strategic planning around both financial and sustainability. Again, an important integration. The next, should I say, pillar kind of thing is the managing, how you manage your ESG risks and opportunities. So obviously, again, the S1 gives guidance that helps companies to identify and manage these risks and opportunities. Again, it's very difficult for the standard to set out specific risks because each company will have different ESG disclosures, ESG impacts, and things like that. So it gives guidance on how to identify your risks and the opportunities. What the standard refers to as risk management information to be disclosed is information to enable investors to understand the process by which a company identifies, assesses, and manages current and anticipated. So it's not just what you're currently facing, but also what you could potentially face in the future, sustainability-related risks and opportunities, and whether that process is integrated, again, there we go, integrated into the overall risk management process. So again, I've said this a couple of times, I'm probably going to say it a couple more times, but it is, again, so your risk management of your ESG risks and sustainability risks, are they incorporated into your overall risk management process? And then obviously this information will then help investors to evaluate the company's overall risk profile and risk management process, not just financial, as we typically have been used to in the past. When it comes to assessing and disclosing metrics and targets, the information to be disclosed there is to enable investors to understand how a company measures, monitors, and manages significant sustainability-related risks and opportunities, and assesses its performance, including progress towards targets it has set. So you are going to disclose your sustainability metrics, which we'll deal with a little bit later, and what those are, and what impact your company has on ESG, and then you would have to set targets on improving those, or where you want to get to, or what, and you would have to then disclose what those so obviously firstly you'll disclose your metrics that you use, then you'll have to disclose your current impact, and then what your target is, and then how you're going to get to that target, and what your plans are in achieving that target. So yeah, it does sound like quite daunting disclosure, but I definitely think it could be very, very useful. Before, I just want to briefly also go through a little bit of other requirements that the standard has. I'm going to use terms now that will probably be familiar to a lot of you that apply normal IFRS standards and are used to normal financial statements disclosure, because a lot of the principles now that I'm going to talk about that are used in S1 have come from the current IFRS standards that we have. Yeah. So firstly, the general requirements exposure draft proposes requiring companies to present a complete set of requires companies to present fairly a complete set of sustainability related financial disclosure. Present fairly, that is a concept we all should be used to now. So what does it mean by fair presentation? Fair presentation is the faithful representation of information about sustainability related risks and opportunities, applying the principles set out in the general requirements exposure, being the S1 standard. The proposed standard requires disclosures of material information about sustainability related risks and opportunities across the company's value chain. So what is referred to as the value chain? The proposed standard defines a value chain as a full range of activities, resources, and relationships related to a company's business model and the external environment in which it operates. So it's very, very broad in what the information and sustainability related risks and opportunities are incorporating. It's quite a wide range of big net, shall I say, that it's capturing. The proposed standard would require companies to provide information that allows investors to assess the connection between the different sustainability related risks and opportunities. So they're not just risks on their own, how they all interact and how they all intertwine and affect each other. It will also require a company to disclose how sustainability related financial information is related to information in the financial statements. So again, I'm going on to the point that it's not two separate things. It's not financial reporting, and it's not sustainability reporting, two separate things. It's one thing, and the standard is requiring integration and your sustainability financial information to talk to your financial statement information that we currently have. So the proposed standard will require sustainability related financial information to be reported at the same time as your financial statements are reported. The standard sets up requirements, as again, terms that you'll be familiar with, requirements for comparative information, the frequency of reporting, the location of information, and things like that. So, and also specify the reporting entity and the related financial statements disclosure, the use of financial data and assumptions, sources of information and outcome uncertainty, errors, and statements of compliance. So all these things are comments that we should be used to, because they've taken it from the standards that are currently available in IFRS, which are the IS1, presentation of financial statements, and IS8 on accounting policies, changes in accounting estimates and errors, is where they've taken these requirements from. So it should be, so we should be familiar with these if we prepare general purpose financial statements, particularly to companies that prepare financial statements in accordance with IFRS. A company would be required to disclose sustainability-related information as part of its general purpose financial framework. And then it would also be required to design, it will also be the requirements to design to ensure that the financial statement information and sustainability-related information are considered together, highlighting the interrelationships, the connection between the different types of risks and opportunities. Again, I know I sound like a broken record by now, but again, it is highlighting the connection between the two, sustainability reporting as well as your financial reporting. So the requirements, the layout, the structure should not be different. Of the reporting is obviously very different, but so how I would imagine this when I was going through this and understanding it is, for example, if you've got a factory somewhere, for example, and you have carbon emissions because you use diesel-operated machinery or whatever it might be, or generators. Firstly, you would have your carbon emission metrics that you would be using. You would then have obviously the impact on the ESG, and that would all be within your PPE disclosure note. So it will all go together and interrelate and talk to one another as one document. Just moving on to then the new S2 standard that they refer to. So this is referred to as the climate-related disclosure. So this is now going to get more specific as to and will be on your impact of climate on climate that the company might have. So a company applying the proposals in the general requirements exposure draft would apply a climate exposure exposure draft to provide material information about its significant climate-related risks and opportunities. The climate exposure draft proposes requiring a company to disclose information that would enable an investor to assess the effects of climate-related risks and opportunities on the enterprise. So if you're applying S1, you would apply S2, and you would then disclose what impact you are having on the environment. So the climate exposure draft uses the very same approach as the general exposure draft. So it would require a company to censor its disclosure on the consideration, again, these terms of governance, strategy, and risk management of a business, and the metrics and targets it uses to measure, monitor, and manage its significant climate-related risks and opportunities. The proposed standard includes a requirement for companies to disclose information about climate-related physical and transitional risks and opportunities. So when it comes to, so I'm not going to go through those pillars again, as I'm referring to, because we've done that already. But again, it bases around strategy, governance, strategy, and risk management. But then it requires you to disclose what impact you're having from a climate point of view. So what are your climate-related performance metrics? These could be anything such as your greenhouse gas emissions, energy consumption, water usage, your waste generation. Those are the kinds of things, the terms that we hear about, global warming and all of those in the market. That would be the metrics that you're using, and these could be different to every company, all depending on what you're doing, and it could be based and what impact you having on your environment and on the climate, and that would be the metrics that you would use to measure and disclose. It also requires sustainability-related targets and progress towards achieving those targets. So again, you have to disclose, once you've identified what your metric is, or two or three, it might be more than one, and impact you have on the climate, you're going to be required to disclose what targets you have to get to a certain level, and then what progress you are making towards achieving those targets. So the environmental and social operations is also then required to be disclosed in what impact you have on your environment and social, the environment that you're operating, what impact your operations have on those areas. So very, very specific disclosure on specific climate-related disclosure is what is required by S2. So just moving on, just some of the, I know I briefly spoke about it in the beginning, but just some benefits of sustainability reporting and why I believe it is important. Sustainability reporting, firstly, in my mind, can increase transparency and accountability, and this can then improve stakeholder engagement and reputation. If you are seen to be a company that's embracing sustainability reporting and applying the requirements of the standard and really disclosing to the market and to the stakeholders what is happening, that this is something definitely that could improve the company's reputation, and without a doubt. It also helps companies manage to identify and manage its ESG risks and opportunities, and this could lead to better risk management. Once you understand the impacts and what your ESG risks are and what opportunities there might be, you might adopt, branch out, or change your normal financial risks, and you might modify those to include whatever ESG risks you might have come up with. Also, I think sustainability reporting can improve the companies. Provide companies with valuable information to better make decisions and improve your performance. So once you are able to identify your risks, I think you can make decisions differently, as opposed to just focusing on decisions that relate to financial statements information. But also, if you understand your ESG impact, it could very well help make better decisions. And then I think I've said this a little bit before, but sustainability reporting definitely can enhance a company's reputation and stakeholder engagement, leading to, I think, an increased trust and loyalty. So if you are seen to be disclosing what needs and embracing sustainability reporting, definitely stakeholder engagement could be improved, and your interactions with these could be definitely improved. And obviously, with the more you do this and the better you do this, the more trust that a user or a stakeholder will have in your company, or an investor even can have in your company. So I think those are just some of the definite benefits I feel that sustainability reporting can have. But without a doubt, as we've seen in IFRS standards, in the adoption of IFRS standards, with anything new, anything different, there are going to be challenges. But with those challenges, also definitely opportunities. One of the initial challenges I think there will definitely be is that companies, when measuring and disclosing sustainability-related information, there's going to be, in the beginning, there's definitely a lack of standardization. What are companies in similar industries doing? So, you've got nothing really to compare to. And also the reliability of, the difficulty in obtaining reliable information. So information is not necessarily going to be easily available, but, this could also be seen as an opportunity, you know what I mean? It could be a way to drive innovation and improving a company's operations or products or services. So look at it that way. So it might be difficult to get the data, but think about ways on how you can get the data. Be innovative, improve on there's areas that you might work that you could identify opportunities for improvement. And like I said, innovation on identifying your sustainability risks and processes. There is the regulatory and investor focus, as I said earlier, has definitely increased around sustainability reporting. There is definitely globally, maybe more so as opposed to in South Africa right now, but it is definitely on its way. So regulators and investors are looking at sustainability a lot closer. So again, this could present opportunities for the company in engaging with them and identifying what they require, what they're looking at, and help you to implement these into your business. But lastly, I just want to say, when it comes to the opportunities, I don't think it's a job for somebody to sit in the corner of a building and come up with sustainability reporting. What I feel is important is that you need to collaborate and engage with stakeholders in this process. That would include investors, it would include creditors, it would include employees, it would include the communities in which you find your businesses in. Engaging all these parties and all these stakeholders will improve sustainability reporting practices and achieve and help you at the end of the day achieving sustainability goals. So I think it's very, very important that we involve other people and not just give it to one person to tick a box. Before I move on to the concluding slide, there are just some questions I think that I was going through that were proposed to the ISSB in the exposure draft, and they addressed some of them in their snapshot summary of the standard. And I just took out 3 that I thought might be worthwhile, because maybe some of you are considering these questions as we're going through this. And these are the questions I just thought, let me just address them and hope everybody's on the same page. So firstly, the first question was, what would a company that applies IFRS standards also be required to comply with the IFRS sustainability disclosures? So the simple answer there is, for now, no. IFRS standards apply to financial statements. Even if a jurisdiction requires the application of IFRS standards, it will decide that jurisdiction or the government will decide whether the companies under its jurisdiction will be required to comply with these sustainability disclosure standards. The proposed general requirements exposure draft would, however, require a company to make a separate statement that it has complied with all the relevant requirements of the IFRS Sustainability Disclosure Standard. So right now, if you apply IFRS, don't worry, it's not mandatory. It won't be that you then have to automatically apply these standards as well. So then that answer, going on to the next question, is, would IFRS Sustainability Disclosure Standards be mandatory? Again, the jurisdictional authorities will decide whether to require the application of these 2 standards, as they do with the IFRS standards. The ISSB, similar to the IASB, does not have the right to mandate the application of its standard. So, however, companies can choose to apply them, but it can't mandatorily make you apply them. So that will be up to this jurisdiction in which you operate as to whether or not these will be mandatory or not. Then I suppose the magic question is, when is the effective date or the proposed standard likely to be effective? This is a question that the ISSB has proposed in the exposure draft. Comments to the exposure draft that was closed at the end of the end of 2022. So they are busy deliberating, going through all the responses, understanding all the responses, understanding how long companies will take to prepare the proposed disclosures and information that needs to be disclosed in these 2 standards. And once they understand all that, they'll give us an effective date. But as soon as the standards are issued companies, the requirements will be available for voluntary adoption if you wish, but the effective date right now is unknown. So it's coming. So just onto a conclusion, to wrap up. Hopefully there was some key takeaways that you got from this presentation, which include the importance of sustainability and why it's important to adopt sustainability reporting. Also, what the requirements of S1 and S2 are. I hope we've got a better understanding of what that is. And also now we understand a little bit what the benefits are. But again, there will be challenges, but hopefully I think the benefit far outweigh the challenges that lie ahead. So hopefully we can understand, hopefully you've got a bit of an understanding on that and what those requirements are. And I would really appeal to everybody to maybe, to adopt these 2 standards when the standards are issued, and you do have an impact on the environment, you have sustainability, you thought about it. I think adopting it right now would be and early would probably be best practice. You know what I mean? Get ahead of the game and don't wait till the effective date. So I think it's definitely benefit, and I'm excited to see what disclosures are going to come out about this. And where this is taking us. There might be new standards, there might be different standards, maybe one day soon or in the future we'll get an S3 or S4 standard, but for now this is what we've got, and I think it's very, very interesting and aligned to where the world is moving to, I think, in all sorts of areas. So thank you very much for your time. I appreciate the time that you had, that you were with us this morning. Enjoy the rest of your day.